Hello, it's Jeff Benjamin, Wealth Management Editor here at ETF.com, talking today with Joanne Bianco, Investment Strategist at BondBloxx ETFs. We're going to get into a little bit of bond math, talking about duration, the inverted yield curve, Fed policy, even bond ladders. It's going to be fun and educational, I promise. Okay, Joanne, how you doing? Thanks for being here.
Thank you for having me, Jeff.
We're going to get into a conversation, a little bit of fun bond math here, talking about a lot of the cash that's sitting on the sidelines, a lot of things going on in the fixed income space. We're going to talk about the Fed and the Fed policy and what's coming with that and what might be driving some new decisions or potential decisions for interest rate cuts this year, maybe as soon as September. But first, I want to talk about this thing called bond duration. All right, we know that our audience is mostly financial advisors. They're smart people. They understand this stuff, but everybody can use a refresher sometimes. And it's easy to get caught up if you're not paying super close attention to some of the distinctions by like duration and maturity. Um, Joanne, if you don't mind, give us a just a kind of a brief refresher on duration, what this means and why it's important.
Sure. So really what duration measures is how sensitive a bond is to interest rate movements. And in terms of measures of duration, modified duration is kind of one of the more popular formulas that people look at. It's
Hmm.
used to determine the effect that a 100 basis point change in interest rates would have on the price of a bond. So that's, and it's basically something that's expressed in years.
Right.
So when interest rates move in one direction, either up or down, bond prices move in the opposite direction. So another way to think of duration in simple terms is that it's the weighted average time until you get paid back from a fixed income investment. It considers how long you'll have to wait for the bond's cash flows, the specifically which are the interest payments and the return of the
Hmm.
principal, and weighs those by the value of each cash flow. So it basically determines the weighted average time for a bondholder to receive the bond's cash flows.
So it's really important to pay attention to duration as we're heading toward a potential Fed rate cut, correct?
Exactly. So paying close attention to duration exposure and fixed income portfolios really helps investors manage their interest rate risks. So
Hmm.
all other things being equal, bonds with higher durations have greater price volatility than bonds with lower durations.
Hmm. Now, if you're a financial advisor, you've got a client maybe with a lot of cash, or just basically you're just kind of dollar cost averaging into a diversified portfolio. Where would what would be a good strategy moving into the fixed income space right now, considering what we've already discussed, the potential rate cut in September, maybe another one later in the year, and the duration context?
Yeah, I mean, we think that there's a lot of opportunities in fixed income, and I'm not here to talk about equities necessarily and the volatility that's associated with them. But so maybe if you're an investor now that is in cash or cash-like instruments, because you've been benefiting from the elevated yields with no risk in this rising rate environment that we saw since 2022.
Hmm.
Um, but now there are many other opportunities that you can take advantage of in fixed income. And so at BondBloxx, we're able to like give a lot of ideas here because we have 24 ETFs across a number of different fixed income asset classes. So in terms of our recommendations, there's a lot of ways you can pivot among them to
Hmm.
take advantage of stuff. So, in terms of our specific investment ideas that we are talking about with our clients right now, um, we have been advocating that they move out on the yield curve and extend in duration.
Hmm.
And we have treasury ETFs that do that in specifically we're looking at our like 3-year, 5-year, and 7-year target duration ETFs, that you could capture outperformance potential if you're anticipating Fed rate cuts starting in September,
Mhm.
which we are.
Would
We
it
also,
would it be
Mhm.
too early to start doing this now, or should you wait until we get closer to the Fed announcement,
Actually,
or
it's
and
better.
can you
Yeah,
be
it's
too late? Can you do this, after the announcement?
I think you want to, I think you need to like position, I think you need to position now. I mean,
Hmm.
actually, we've been advocating this for some time. Actually, since the we were definitely like focused on the short to the maybe the closer to the short end of the intermediate part of the curve
Hmm.
earlier this year in terms of what we thought in US Treasuries would be the best opportunities. But especially after we saw Chairman Powell speak in the last Fed meeting and his signaling of that they're going to focus more in terms of their dual mandate on the labor market and not just inflation and the labor
Hmm.
market decreasing. It made us more confident that the case for rate cuts has been bolstered. So that's why we think, yeah, no reason to wait to go out in duration to capture outperformance.
But we're not talking you. It sounded like you said 7 years was the longest you mentioned. What if you're
Right.
longer than that? Should you be pulling back your duration on the fixed income side?
No, I mean it really it is it's I mean, we have our views, but obviously there are different reasons to be in all different spots on the duration curve if you're an investor, depending upon your investment goals and risk tolerance. I mean, obviously, the longest duration instruments are going to be the most volatile, but over a more extended time horizon, you probably are paid for that risk. It's
Okay.
just you will have more volatility in the near term being long in treasuries.
Okay.
So if our X7 is the it's XSVN it's a target duration US Treasury index. So it targets the precise duration of 7 years. That's actually close to what a 10-year maturity for a US Treasury is. It's actually the duration of a 10-year is around 8 now. So it's a little shorter than that. So it's not that we're saying a 7-year maturity, we're saying a 7-year duration.
Okay. Let's talk about Fed policy for a little bit. The general consensus is that there will be a quarter point cut in September and likely another quarter point cut later this year. We came into this year with people talking about 6 rate cuts. Um, where are you on that? And how should investors look at this Fed policy? Is it as clean as likely 2 cuts this year?
Uh, we have to continue to see how the data develops
Hmm.
to see if it's 2 cuts or more. But
Uh-huh.
yes, bond traders have repeatedly, actually over the past year now, been too optimistic in pricing rate cuts by the Fed. Actually, only to be caught on the wrong side of the trade when the US economy continues to exhibit resilience. But
Hmm.
that being said, we do believe that the case for rate cuts has been bolstered by recent data. Whether the Fed starts with a 25 basis point or 50 basis point rate cut in September, I mean, our view is that we think that the Fed will remain measured in their approach and cut rates by 25 basis points at the September meeting. But no matter what they decide to do, the fact that we've been recommending to our clients that they extend out in the duration curve, they would benefit in a rate cutting environment either way.
Okay. You also mentioned the yield curve. The yield curve is inverted. It's been inverted for, I think, the longest time in history.
Mhm.
As a, I mean, you guys are all about bonds. How does this influence fixed income investing?
Yeah, This is a really interesting question you've asked. Let's step back first. Prior to this curve inversion, historical curve inversions have signaled a recession the past 8 out of 8 recessions.
Hmm.
And they provided the signal around an average of 10 months in advance with no false signals. So fast forward to now, and you're right, it's been a record number of months of inversion, actually 26 months of inversion. But
Hmm.
this time there is no real sign until recently that the economy is starting to slow. Many people are questioning whether this indicator is still working or why it is not working. Short rates being higher than long rates is supposed to signal tight monetary policy. And
Hmm.
then this is supposed to get transmitted into the banking system into like a higher cost of funding for loans, which is then in turn supposed to slow down growth and the economy. But since it's been 26 months of inversion and there is no sign of the economy really slowing until recently, the inversion signal is being called into question in
Yeah.
terms of its predictability. But maybe the reason that, the reason for the change this time around is that we have a lot more credit channels for lending in the economy, like private credit. So this could be one of the reasons why smaller businesses aren't struggling more.
Hmm. What's your outlook for the yield curve? Do you see it disinverting anytime soon? I know there are parts of it that are coming back to normal, but
Right.
what are your thoughts on it?
Well, it's certainly flattened for the year in terms of there's there's been a flattening of the curve between shorter rates and longer rates. And
Hmm.
over time, we're expecting to see more of a normalization of the
Uh-huh.
yield curve as the Fed brings, short rates are artificially held higher by Fed rate policy. And so when they do start to bring rates down, we think we could see a more normalization of the yield curve.
Right. What about a yield curve that doesn't see the short end go down and the long end goes up? Is that conceivable?
If the Fed decides not to cut rates.
Well, what if they don't cut? I mean, they're at 5.25, 5.5 right
Right.
now. What if they don't cut enough?
Well, there is definitely that argument out there that the neutral rate is higher, that we're not going to go back to the long rates or to the short rates that we saw before that were like what, 25 basis points for Fed funds.
Right.
So the neutral rate could be more in the high 2% to the low 3% range. So, but that would still potentially be a normalized yield curve if the Fed got there with rate cuts.
Yeah, we're a
They
long
don't
way
need to
from,
go back all the way where they were before.
but I'm not even talking about 25 basis points. We're a long way from 2% right now.
Right. Okay. Yes. But if you look at the world interest rate probabilities, it's basically telegraphing, and yes, the market and can be wrong in this, but
Hmm.
there's the view that there could be rate cuts at the next 5 or 6 meetings, and so that gradually brings short
Okay.
rates down. Mhm.
All right. Um, we talked a little bit about cash on the sidelines, and that kind of folds into the yield curve issue. Obviously, if you're getting 5% or so to sit in a money market fund or some kind of a cash equivalent, why do anything else? And this little rate cut that we're expecting in September, I think people are saying is gonna trigger some activity,
Mhm.
right? Do you anticipate that that there will be money moving off the sidelines for a quarter point rate cut? And if so, where should it go in your expert opinion?
Yeah, it's already moving, but yes, you're right. It could accelerate that. But I think that in our view, we still like the corporate credit markets of the fixed income universe.
Hmm.
So investment grade corporate credit, particularly triple Bs, and then also the US high yield market. We like the elevated yields available amid, still resilient corporate fundamentals. We're not expecting a significant weakness or deterioration in the
Hmm.
corporate credit markets. And from that perspective, like, why not earn the extra income that you can get from corporate credit areas versus just staying in treasuries or just staying in cash-like instruments.
Hmm.
So coupon income is the primary determinant of returns for US high yield, for triple B corporates. So we just think, earn that extra income.
Hmm. Hmm. At what point is it going to be not good to be sitting in cash? Will the Fed have to cut, like you said, 5 or 6 times, or dramatic
Well,
cuts?
yeah, I think you're already subjecting yourself to potential reinvestment risk if the longer you stay in
Hmm.
cash-like instruments. You probably need to look at other things, because it's been great for a lot of investors to be in cash-like instruments, but it's not going to be the rewarding area that it was, and so you need to look elsewhere.
Okay. Final thing I want to talk to you about, Joanne, is bond ladders. All right. Financial advisors, some love bond ladders, some don't. People like yourself, I find also a mixed bag of love or not love. I don't find a lot of people neutral on bond ladders. There are ETFs out there that make bond laddering so easy.
Mhm.
Is there I mean, do you have a feeling one way or another on bond ladders? And then, is there a break even point on bond ladders where it makes sense for some people and not for others?
Mhm. Yeah, I guess in our opinion, the main benefit for a bond ladder would be when the investor's goal is to match their portfolio's cash flows with their liabilities. But for
Hmm.
the vast majority of advisors and the clients that they serve, it does seem like the likely appeal of bond ladders is probably based on that principal at maturity myth, or the certainty that the bond ladder provides. So clients that want their advisors to focus on bond ladders, it probably stems from the view that they're worried about potential losses that bond funds would sell at when rates rise,
Hmm.
while ladders of individual bonds can be held to maturity and avoid losses. But ultimately, bond ETFs, not even laddered approach bond ETFs, but like our Treasury suite, for example, you can have them operate, the same way as a ladder. If you are reinvesting your cash flows anyway. But the
Hmm.
benefit of ETFs like our Treasury suite is that they can offer greater return opportunities just by the virtue of their lower reinvestment risks. So, you have to wait till your bond matures in the ladder to then, reinvest that into, a new, like, probably lower yielding instrument. The bond funds don't have that same reinvestment risk as the managers of ladders would in a declining rate environment, because they're not waiting to reinvest. Um,
Right.
Plus, ETFs can offer lower transaction costs, and there's better liquidity. You don't have to wait to maturity. And there's also the time savings for the advisor and their clients from having to build and maintain the ladders. So, in a nutshell, like, given the higher risks, the higher costs associated with these portfolio of individual bonds in ladder form and the time they take to manage, we do feel very strongly that advisors are better served by investing in low cost ETFs.
Right, but there are ETFs now that are structured as individual bonds for bond laddering purposes.
Right, but
I'm
then they still have the same reinvestment risk. It's just from the ETF. They have to reinvest.
Right, but I'm wondering if the bond ladders and the bond laddering strategies are kind of like the, target date funds. For financial advisors or individual investors, they can say, well, I'm going to build this ladder out as long as I want to. As they mature, I'll make a decision. I'll reinvest. I'll buy another rung of the ladder, or I'll spend that money if I'm in retirement, or I'll use that money to rebalance and buy more equities or something like that. Um, like I said, I see all sides of bond laddering, and it is kind of interesting how it's such a it not such a, but it can be a divisive issue. Some people think that they're, like you said, they're a little bit too time consuming, and maybe you're bringing risk into play that you don't need to. Other people say this makes it easy for me to look at my fixed income side. I know what I'm getting, and I know when I'm getting it, and I'll figure out what to do with it at that time. You know?
Yeah, I guess, yeah, definitely there's arguments on both sides, but I think for us it's you still have liquidity, low transaction costs, and it's really more about the time in the market versus timing the market.
Hmm.
So we think um you probably over time, if you are reinvesting, you are probably getting similar economics with either strategy, but the potential for lower costs by using just like a non-laddered approach.
Okay. All right, Joanne, we're going to leave it there. That's a little primer for some folks on duration and some other things in our, we're going to call this the start of a little bit of a bond math series. Hopefully we get Joanna on again to talk about something else in the fixed income space as it happens. Maybe we'll get in touch in a couple of months after we've seen a rate hike or two. How about that?
That sounds great. I'd be really happy to do this again with you, Jeff.
All right. Thank you very much for being here.
You're welcome. Thank you.
All right, folks, that's another episode of Advisor Upside, powered by ETF.com. Be sure to check out ETF.com and the Advisor Center for everything you need to know for financial advisors, news, information, tutorials, cool podcasts, webinars. It's all right there. If you want to reach me, you can find me on X. My handle is @BenjiWriter, or you can email me, jeff.benjamin@etf.com. Talk to you next time.